Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our Tuesday night live show, and I'm really excited tonight because we have just an action-packed show for you guys. We're going to go over a lot of different topics. We have an agent that's on deck down in Clearwater, Florida, embracing for this storm, and Drew Fellios, he's going to be coming in with us here very soon. And I think we may even have one of our callers or audience members call in that recently we published a video about title companies and the title policies, whether they're good for home buyers. And I just interviewed a attorney in Texas that has a company that is now offering attorney opinion letters. AOL is the acronym for that. And instead of title policy saving people thousands of dollars, I'm not advocating one way or another. I just am trying to bring you the data as to, trying to get your costs down, home buyers' costs down, and then also, it's necessary. So we're uncovering all kinds of fees and transactional mishaps that you could be going through as a buyer or seller, and we're trying to bring those out and make you more educated as consumers. We're going to talk about the Fed dropping interest rates. We're going to go over some charts tonight, show you what I think is going to happen as a result of, or what this is indicating is with the Fed dropping the rates. We have a poll. If you guys haven't checked it out yet, we want to bounce over to that periodically throughout the evening. And this poll is really trying to get your opinion on where you think the economy is right now, and what the Fed may be thinking. Why now are they cutting rates? Have we achieved the goals? Is the threat of inflation gone? So we have down right now, we're hoping that you can go over and vote, and we'll see how this fares out through the evening. But it looks like most people right now say that the Fed knows that the shit's going to hit the fan, and that's what we're kind of where we're headed in that direction with this poll. So we're going to dive into it tonight. We're going to talk about the policy change of the Fed. We're also going to go over what's happening in the current real estate market around the country. I talk to brokers and agents everywhere, really. We're going to talk about what they're seeing and feeling in the marketplace. They're feeling pain. I can tell you that. Many agents are feeling pain, at least the top producing agents, the ones that haven't produced over the years. They're in it for other reasons. Maybe they're hobbyists, or they do it just to help their friends or their family buy and sell houses. But the ones that are really in it full time are starting to feel the pain. And now with the new rules, the commission rules, it's not making it any easier on anybody in the industry. Not much change here in Maryland. We've always had buyer agency contracts as far back as I can remember. But anyway, we're going to dive in tonight. Let's without further ado, we're going to bring in Drew Fellios, Clearwater, Florida. Bring him in here. Hey, Drew, what's going on, man? How are you?
I'm just thrilled to join you tonight. As you stated, Todd, lots going on down here. Getting ready for that storm. Hopefully, it's not too bad. But other than that, things are going pretty nice here in the real estate world.
Well, I mean, you and I have talked before about how much I love Clearwater, and I know you serve surrounding areas as well. But one of my favorite places to go is Reddington Beach, North Reddington Beach, and it's kind of one of those little pockets where there's not a lot of tourists, and the water's nice, the beach is nice, and the people are really friendly, and lots of good places to eat, and I love that. But just kind of give us an overview now, just to let everybody know we have a broker network all throughout the country. It's new to us here at Sachs Realty within the last year. You can go to SachsRealty.com. We have a map of the U.S. You'll find Drew there in Clearwater, Florida. But what we try and do is, through this process, is bring people to you that we feel, confident through an interview process that they're they're going to take care of you guys out there, and we believe that. And with Drew, but tell us what's going on, man. You've been in the business not a long time, about 4 years, coming up on 5 years, and but just tell us what you're seeing. You serve mostly buyers, right?
Yes, I do. And in 2020, I'll never forget, whenever I first kind of jumped into the fray, this thing was absolutely full speed ahead. Even though I was just getting into the business, I could feel that there had never been anything quite like this as far as just buying a simple property. And for me at the time, Todd, obviously when you live in an area like this, you've got the beaches, you've got a bunch of condos, you've got, obviously some beautiful homes near the coast. And then you've just, as you kind of venture more into Clearwater and then Tampa, you just have some sort of like the normal properties, the homes. I tried to sell as many just normal properties as I could, because anytime we're dealing with the investors and the folks coming from north who were really trying to, make that big investment, that was tricky. And at the time, watching this podcast and staying, up to date with everything that was going on in our nation, you just knew that things were going too fast. And you knew that at one point there would be that great turnaround. And, I will say that, Todd, I lived in a condo that I bought in 2019, and I bought it for $300,000. And one day, watching this podcast, I looked at the chart, and it had absolutely all the way gone, up to here, and put it up for sale and got a $600,000 offer, just for a condo. And I knew, even though I love the condo, that this was crazy. So I, sold the condo, and now I just live in a house, and I'm good with my decision. But it was just crazy. I mean, now it has completely turned around.
Well, I just want to touch on a couple things, because you bought it in 2019. So when did you end up selling it?
Sold it in June of 2022.
Mm-hmm.
And I got it.
You profited. Put that money in your pocket. Yeah, because you could.
Yeah. And the thing about it was the offer that I got was a sight unseen offer for the condo. I was on a 5th floor, and Todd, my condo needed new windows. When we had storms, the windows would shake. So anybody that came to see the property would see that and ask me about that. And I would tell them, yeah, it needed new windows. Well, this offer that I got from out of state, they did not care about the windows. They wanted the property. And obviously they put together an offer that, I simply could not refuse.
Well, you sold at sort of the peak of the market. And for people that are listening, especially for first-time buyers that maybe bought in 2019 or 2020, you're allowed if you live in the property as your primary residence for 2 years, you can profit $250,000 as a single person and $500,000 as a married couple. So a lot of people really capitalized and took advantage of that. Fast forward to now, you said it's really turned around. Kind of give us the climate. I hear a lot about Florida taking a hit. The condo market, to me, is a very risky market. I don't personally like condominium associations. Again, personally, I have clients that buy condos. I have clients that buy in HOAs. I don't really care for either one of those. I have a story tonight I want to share much later about a recent deal with the HOA. But what are you seeing as far as the sales?
Well, to put it in perspective, that condo HOA that I lived in at the time was $550 a month HOA. You got a lot of little perks. It had a little private beach. You had 3 swimming pools, and part of that HOA covered your flood insurance. So when you lived in one of those condos, all you needed to purchase was a HO6 inside the walls policy. Well, that $550 HOA, Todd, right now in that same building has ballooned to $1,100. It has doubled, and a lot
$6,000 a year. Double. I mean, it's increased $6,000 a year.
Mm-hmm. And that was again, one of the more solid HOAs on the entire beach. So that kind of gives you a perspective there. And I know that the condos, there are listings now in that complex for $395, $410, $425. Now there are literally folks trying to just, unload and get out. So that kind of gives you a perspective of where it's at right now there.
Well, I can remember back in the GFC going to Orlando, and I forget what it's called, Millennium or Millennial or what, whatever the community is, right off of right in Orlando near Universal Studios, not far from there. Mall there. I could buy in the GFC, you could buy a 2-bedroom condominium for $25,000, $30,000. They were just, nobody wanted them. And the bad thing with condos, people have to realize, is if people aren't paying their condo fees, it increases the liability on the ones that are. I mean, you're owning that building, together, right? So your grounds, your building. So this was an HOA and a condo, both?
Yeah. So the HOA, this was a big complex where there were 4 towers, and then there were little low-rising 3 stories buildings on the outside of it. But our buildings were 9 floors each, and we shared an HOA just with the building right next to us. So when we voted to paint the property back in 2021, gave it a nice, modern look to it, and little by little, and our reserves were healthy. They were great, but still, because of the rules and because of all the things going on, the HOA doubled. And just all together, Todd, that's where I think right now the folks are feeling some pain. The folks that are selling condos here, Clearwater, Bel Air, places that you mentioned, Treasure Island, Reddington Beach, those areas right now are being hit really hard right now at the moment.
Well, what's happening is the explosion in condo fees from costs to maintain the property, and the insurance and the taxes are suppressing. They're extracting the equity out of the owners, and no one was thinking about that. And this has happened nationwide. I mean, this super bubble that was created in the housing market, I've never seen anything like it before. I've been saying since 2022, that it's not sustainable. We've outpaced wage growth. I have a couple of it's been a very busy week here because there's so much going on, so much to cover. But I was podcasting with Jasprit Singh. He has a show called Minority Mindset, and we were podcasting today. We're actually getting ready to do a face-to-face podcast with him. But he was just talking about, how wage growth in the last 4 or 5 years has gone up 20%. But I think that we're really misleading the wage growth with the information. 800,000 jobs were overstated in 2023. That was leaked from the Bureau of Labor and Statistics. So those jobs didn't exist. We were pumping and pumping and pumping and pumping, right? And because of the lagging and misinformation. The other thing is that we are forgetting that during that period of time, the reason why wage growth went up so much is because people needed employees, so they were paying bonuses, they were giving them increases in pay to keep them, and because business was booming. I mean, we flushed the economy with cash. The supply chain was restricted, but we were finding a way to buy products, and people needed employees to grab those dollars. Well, now what's happened, that money's been sucked out of the economy. We're starting to see the implosion of jobs. And what's going on with that is, people are getting laid off. So, and now when you're looking at threats of AI, trying to replace people, people have bought these assets at the highest prices, and now they're trying to sell them because they're like, man, I overspent, and now they're trying to sell them, and they can't. If you bought it in 2019, 20, I mean, you probably still can, but, what we're seeing is people that purchased in 2022, 2023, they're already wanting to get out. So when we're considering what's going on, and we've got some data, guys, we're backing this up with data tonight, because I'm telling you right now, if you ignore this data, it would be the first time in the history of the United States that we skirted a recession. And when we look at these data points, and some of them have been changed throughout the months, adjusted, but we can't get away from the fact that the numbers are the numbers. And one of the things, so Drew, I just want to, and we'll have you hang out here with us, and we'll just kind of get your opinion on some things as we go along. And guys, we're probably going to take some callers tonight. Hopefully we're going to have time for that. So if you have a story to tell, if you're a buyer or seller, you have a question you want to ask Drew, myself, come on. And, let's talk about it and see what we can do to point you in the right direction, because that's why we're here. We do this show to be able, we're a real estate company. Drew's an agent in Florida. We're a real estate company here with a big reach. And, a lot of what we do when we bring this data, we probably cover it more than anybody else is covering real estate. Even though we talk about the economy and things like that, our nature here is what we do is help people buy and sell and try and save money wherever we can on the housing market. But anyway, let's. I want to bring up a couple. Well, before we go into the charts, do you think this is, when you're seeing these prices drop in your market, do you think this is the beginning or the end?
Ooh. There's just so much talk about that presidential election. That's the consensus I'm getting right now from buyers all over the place. And you're really going to see, I think, once that election is over and once we get into December, January, February, really where I think this economy is at. I think that's going to be the real wake-up call. But, just speaking of that condo, I should add, that particular condo did not allow Airbnb. That was, you had to live there a couple years before you could even let somebody rent it, someone live there other than yourself, the owner. I have dealt with a lot of Airbnb properties, Todd, and that, you talk about air going out of the balloon. That has been an absolute thing. And that's something that just me as a consumer, I considered that during that time, 2021, 2022, because that was the hottest thing since sliced bread while it was enjoying its run right there. But so many of these communities around here have cracked down on it. Indian Rocks Beach, an area close by, known for that. Every time I pick up a newspaper, they're having another meeting in those neighborhoods about trying to figure out ways to restrict it. And there's many properties, too, that I helped clients buy during that particular time, and they're having a hard time selling those properties right now. So ones that are in those zones where there's no HOA, they're unincorporated, it has not been the hot thing that it was back in 2021 for sure.
Well, and I hear story after story about people just hoping that their profits will come back. They bought with the intention of getting rich on these Airbnbs, using them themselves as vacation properties. And of course, they're expensive. The neighbors hate it. And, to maintain, it's expensive. The reviews kill you. But the ones that make the money are the websites, these short-term rental websites. They just rake in the fees. When you look at the billions, it's crazy the amount of money, billions of dollars that these companies make off of people that went out and bought these houses and invested. Now, I get it. They have the platform. But back in the day when you bought an investment property on a beach, in a beach town or a vacation rental, you hired a local rental company, rental agency, and they actually managed it for you. They would, you basically just paid them a percentage of the fee, but you could still make money. Now, with the way that they've stripped the fees, or added these fees, they've stripped the profits out. And of course, there's a lot of choices. So now, depending on what site you go to, it's all about the tenant, not the host, right? It's all about the guest. And so, I saw this thing coming like a freight train. I saw people buying properties that they had no right to do. People, they don't realize self-employment, 80% of sole proprietorships fail within the first 2 years, right? So the key here is that people with money bought these things. So, you had people who thought that they were cash flush, they had plenty of money, and now they're bleeding out, right? They're like, wow, this thing is really costing me. They've jacked me up, they've prevented me from having rental, short-term rentals, or I have to rent it for a month at a time now because the HOA or the township or the county has eliminated it. So now I have this property, and it's just killing me with high utility bills and costs. So I think that's one of the things that's going to add a ton of inventory to our market here. And I don't think, look, I hear what you're saying. People are very cautious. I hear it too. If I hear it once, I hear it a dozen times about they're waiting for the election. I don't think it's going to matter. I think what's happening is this can's been kicked down the road so far that, just like Obama and, had that handed to him when he took office, it's going to be something that whoever's the president is not going to be easy to deal with. Now, I will say that we have learned a whole lot. The government has learned a whole lot about avoiding, things and printing money and we have the longest run we've had, I think, historically without a recession, or they've redefined what the name of a downturn is. Maybe it's not recession anymore, but we can't get past the fact that a lot of the buyers and sellers, look, we're seeing a slowdown big time in sales. I mean, across the country. I've got a chart. We're going to look at it. Existing home sales are way down. And but anyway, let's dive into the data a little bit here. So what we know here, guys, is that on September 18th, the Federal Reserve announced that they were cutting interest rates by 50 basis points. Now, for a lot of people, they don't know what that means. So when we started hiking interest rates back in March of 22, we hiked, not me, the Fed hiked interest rates the fastest and the highest they have ever done before, and in a shorter period of time. So they really screeched the brakes on the economy. Now, there was a lag effect when the Fed makes a decision, and what they do, there's a couple of quarterly terms that we have to go through before we see that lag effect show up. A lot of it is we're in denial, right? So you're cruising around all of a sudden and the car just stops running, one day. I mean, you're driving, you're like, well, the gas tank looks like it has enough gas in it. And then all of a sudden you're like, where did it all go? Boom. I'm sitting on the side of the road, right? So one of the things that, we know, first let me define what the Fed rate is, because a lot of people think that the Fed rate they're going to drop the rate and we're going to instantly see something like mortgage rates reduce. Or maybe your 35%, 34.9999999% credit card bill, interest rate will all of a sudden be like, wow, now I'm going to get a better credit card rate because the Fed just dropped the rates. Or maybe that auto loan that you're paying for, you're hoping that will go down. The Fed rate is actually the overnight trading rate. It is the price where money is borrowed. The banks borrow the money at that rate is set by the Federal Reserve, and it's what the banks can go to, the overnight trading rate, and borrow money so that they can lend you money. So their juice, if you will, or their profit on top of that rate, yeah, sure, they could bring that down a little bit, but we're not talking about a huge number right now. We're talking about a half a basis point, 50 basis points, sorry. So what I want to do is I want to pull up a chart here, all right? So if you guys can just hang with me here, because I want to kind of go over this chart in a little bit of detail to kind of contextualize over the period of time. And by the way, the Fed, when they're changing policy here, they're planning on more rate cuts. They have another meeting November 6th and 7th. We'll get an announcement on the 7th. They have another meeting the 17th and 18th of December. Now, interestingly enough, the November one is They're meeting the day after the election. So at the time when that's going on, the Fed's going to be meeting and talking about monetary policy. But they're also saying that we're going to expect more cuts as we get into 2025, right? So anyway, let's go ahead. And so the Fed is saying that the reason is because that they're cutting is because it's time. We have hit that plateau that they've been trying to achieve in reducing inflation. Now, one of the things I want to talk about with inflation is they're talking about disinflation. They're not talking about deflation like we would like to see, right? Where all of a sudden you go into the grocery store and things are cheaper, or your utility bill has gone down, or the cost of things have gone down. We're talking about disinflation. We're talking about the annual rate of inflation from one year to the next. So if you spread that out and you slow down the economy by raising rates, and you spread that out long enough, you'll see where you can achieve maybe a 2 or 3% year over year inflation rate from where it was just a year ago. Again, that's not taking into account that we've seen things go up 40, 50, 80%, 100% or more. Drew just gave us an example where a condominium doubled in rates. So imagine a buyer that buys a condo and they're on a fixed budget. And now all of a sudden their payment, just in one sector alone, not counting taxes, their payment has gone up, is doubled in HOA or condo fees. And that's $6,000 a year. That's a big number, right? When somebody's buying a $600,000 property that's now hopefully selling at $350,000 or $400,000. So that's really what their property is selling at, and it's probably worth a lot less than that. So when you look at, they're not going to drop those condo rates because the price dropped of the condo $150,000. No, in fact, your condo rates are going to continue to go up because you're in a condo regime where those people make, the ones running the board are making the decisions on your behalf, whether you like it or not. So, and a lot of people get on the board, believe me, to spend money. They get on, they have money. They don't care about the rest of the people. They want new foyer carpet. They want new furniture. They want new elevator, facade on the inside of the elevator, new grounds, new landscaping. They don't want to cut costs. That's who gets on the board most of the time. So, and they're hoping that, well, we got to keep up our, value. Meanwhile, it's dropping like a rock. But let's look at this chart a little bit, because I want to break down some of the things that have happened before when the Fed dropped interest rates. Now, I want to take us back. I want to go back a little ways. So this chart goes all the way back to 1954. Fair enough. I mean, I think we have a little bit of history here that we can look at. I wasn't even born in 1954. I know Drew wasn't. But I want to focus on a couple things, because these gray bars are what we used to know as recessions, which by the technical term meant 2 consecutive quarters of, falling GDP, negative GDP growth. Again, we found a way around that so we don't have to call it recessions anymore. I think that everybody has heard, if you listen to even mainstream media, that they redefined what a recession was. But I just want to take a minute and look at some of these things, because in 1958, the Fed started to drop interest rates. This is the Fed effective rate, the overnight trading rate. They started to drop interest rates. And look what happened. That gray bar showed up. In 1958, it was a Eisenhower recession. It was a sharp worldwide economic downturn. And then we cruised along. And another thing I want you to pay attention to is there were recessions quite frequently. This is the longest run over here, most recently without a recession, because you really can't consider the 2020 recession a real recession, because they quickly got us out of that. But when you look at 1960, the Fed started dropping rates. Now, here we go again. Boom, 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 boom. Rates go up. They decide, okay, let's drop rates. So we're here at 1960, right around 1960 with a recession. We had a worldwide economic downturn there. And then in 1970, 1969, 1970, the recession actually started in 1968. It was an economic slump and then turned into a full-blown recession by 1970. And then, but you could see, I mean, it's consistent, right? Here we go. The Fed just started their drop rates and boom, right there we are at a full-blown recession. All right, here we go. Now we're traveling back up again, and we're getting up to this 1979. And 1973 to 1975, we had an oil shock recession that finally ended the post-World War II economic expansion. It was a boom. And but this was the most severe economic contraction in a post-war era. And basically, we cruise along here until we get to the 1980s, 1981, same thing, start reducing rates. There we are, boom, severe economic downturn that affected the U.S. and other parts of the world. Now, by this point, what we did in the 1970s was we took millions of our jobs and we shipped them offshore. So now we really start to see where the recessions affect the global economy, right? Where now we don't make anything anymore. We take our, whatever it was, 4 or 5 million manufacturing jobs. We offshored that, thinking that that was going to be a great thing for our country. I can personally remember, I grew up in this era where things were stamped made in the USA. Man, it really meant something. You knew it was a product that was going to last. It wasn't like half the junk you buy in Walmart that you take home and it breaks 5 times after you used it. And, so, I mean, this is real stuff, right? I mean, I was noticing the other day, I wear belts. You can't find a good belt. They all fall apart. They start to, and I need a belt. But what happens is, even the leather. I mean, it's not, it's, come on, man, it's junk. Look at our automobiles, junk. Look at the things that are made. I mean, you need all these airbags and safety devices because they're junk, right? I mean, they're not like the old cars that we used to have when you had the safety belt, around the waist, and most of the time you didn't even wear one. Now you need it, right? So where are we going with this thing, right? We're expensive, overpriced junk. But anyway, we're cruising right along here, right? And you've got the same thing happen in 1990. You got the same thing that happened in the dot-com bust. And by the way, the dot-com bust, we lost about 1.3 million jobs, right? Almost overnight. So when we're looking, but the point that I'm getting at here is that there's a pattern of the manipulation of the federal fund rate, the effective rate, to bad times ahead. But what I really want you to pay attention to here is the flattening effect. The flattening effect that seems to get greater with the Fed rates. So if you look here, we had spikes, almost mountaintop peaks, fast drops in rates. And as we have learned some things through the years, it's interesting that we don't see mountaintops anymore. We see mountaintops that have been shaved off flat. So we saw that first really show up right at the dot-com bust. Excuse me. We really saw it happen in the GFC. By the way, the Fed had testified to Congress back before it really hit the fan that the housing market was good. It was Bernanke was the Fed chair, and that everything was good in the housing market. And then I get it, it's a self-fulfilled prophecy. If they come out and say it's a disaster, then it becomes an instant disaster. But here we go with the biggest housing and financial global downturn that we've had since World War II was in 2008. So what did the Fed do to respond to that? Well, they dropped the Fed rate to almost zero. Free money, guys. If you were a bank, there were institutions that became banks just so they could take advantage of the free money. Don't believe me? Look it up, Google it, research it. But we had financial institutions becoming banks overnight so that they could grab this free money and lend it to you and me. Well, what happened with that? Well, we started seeing asset class bubbles and really build up, and we can see that by this rate that stayed almost at zero until we got right to about 2016. Now, one of the things that I want to talk about, because it's very rarely mentioned, is that when we were before the pandemic in 2019, we were actually headed into a major recession. Look, here you go. They started dropping rates in 2019. That's usually what happens. They go, wait a minute, guys. Yeah, we're getting up there. We pushed it, the envelope. The banks maybe aren't as strong. Maybe we're seeing some insolvency. We better lay off the throttle, stimulate that economy. They were doing that in 2019, right? With backing down this Fed rate. You can see that. Here it is. This is almost a year earlier that they started to back down their Fed rate. And then what happened? Well, we all know what happened. We were in full-blown lockdown, and then they dropped the rate even lower. They flatlined us. We were seeing people getting mortgages for purchases. Now, refinance mortgages are not typically as cheap as a new purchase, whether it's an existing home that you purchased, it's a new purchase, or a brand new home. So we saw people for a period of time that were buying houses with 2.74% 30-year fixed rate mortgages. The banks are insolvent at that point, right? Especially after the Fed jacks up the interest rates. And here's what happened, right? We watch. If you look at that line here, it's almost vertical, right? A very high spike in a very short period of time that we watched the Fed drive those rates. And now look what's happened. We're getting that same flattening effect, and that's about to come down. So the question that really is, in everybody's mind out there is, can we avoid a recession? Well, let's not even call it a recession, because they can probably make sure that we do not have 2 negative quarters of GDP growth by printing more money. But the question is, are we going to have a recession in your pocket and a drawback even more from consumers? I think the answer is yes, because of what we're seeing now in the economy with the closing of businesses, the layoffs that are happening, the people pulling in their spending. Certainly the housing market is really in bad shape. Now, before I go any further, Drew, do you have any comments or anything you want to add to this chart that we have here?
Yeah. Makes a lot of sense. Yesterday, I know this is a little bit off topic, but yesterday here in the Tampa Bay area, we found out that one of the most popular restaurant little institutions right in the heart of Tampa, called Goody Goody. It's a little hamburger place owned and operated by the most successful restaurant guy here in the entire Tampa Bay area. His name is Richard Gonsmart. He operates the restaurant Columbia Restaurant. I know a lot of folks around the country love to come to Tampa to eat there. But they decided that the Goody Goody hamburger chain is to be no more. They're going to shutter it beginning the end of this week. That's just an example, when you start seeing that from really successful folks starting to kind of hedge and cut their losses there, obviously, you see what is going on there. The other thing I'd like to add is, still working with buyers right now, not as many, obviously, as I was 2 years ago. But Todd, as soon as I show a buyer a property, as soon as we walk out the door, I'm getting a phone call from that listing agent. What they think? What they think? Feedback. It's almost like you're feeling not just an agent that wants to sell a home, but desperate agents that really are thirsty to get offers for their property. So you can just feel it right now. If you are a buyer and you are going through a life change and you want to buy a home, I would say absolutely shop around. And as you know, Todd, to make a great deal, you don't just need a great buyer, you need a great seller as well. And I constantly preach to my clients, let's find a seller that really, really wants to sell. because I promise you they're out there right now and they're only going to multiply here in the coming months.
Well, what I love about you, Drew, is that you're not cheerleading.
No.
You represent your buyers, and I know we've talked about this. You work with them sometimes for 4, 5, 6 months. You don't get frustrated with them. You don't push them. You're really looking out for them, which we need more than ever in this business. And we're going to talk about this in a little while. I have a whole little segment here that I want to go over about if you're a buyer or a seller, what you should be doing. And we're going to lean on you on that segment here very, very soon. But yeah, I mean, so guys, we're going to move on from this chart here. Obviously you can look this chart up online. It's an interactive chart. It is, the numbers don't lie. I want to go into the next thing I want to talk about is mortgage rates, because we were just kind of hitting on that. This is what has been the biggest driver of the housing asset class, and probably one of the biggest catastrophes for building owners that are struggling with their commercial properties. And this is something, guys, that we're not even addressing. We're not even hearing it being mentioned. The deals that these banks are making on commercial properties, these loans that are being extended that are not qualified. These are non-qualified borrowers or loans that are on the bank's books. And what has happened is because of the interest rate disaster that we've gotten ourselves into. Now, just to kind of piece that out for a minute so that you guys can understand the implications of commercial real estate, because a lot of you don't really care about commercial real estate. You don't even think that it affects you very much, but it does. Because what you don't realize is that's your community that you bought into. So when you're buying a house, a lot of people bought because of that burger shop or that Target that's there or that Walgreens on the corner, or the collectivity of all of those businesses together that make the community, right? And what happens is on a corporate level, and we saw this in 2008, publicly traded companies and large companies like the chain that Drew just mentioned, they just cut their losses. They don't care about the jobs. Not that they don't care about the people, but they care about their profits and their bottom lines. I don't blame them. I mean, that's what they're in business for. But you have to understand that they just shut it down. They're like, you know what? This is going to be a 10-year deal. We're not going to lose money for 10 years. We'll even still pay the lease. A lot of businesses will shut it down, and that place will sit vacant for years, and that business is still paying the lease. For them, it's cheaper to pay the lease empty than it is to have a dying business that's costing them even more money than paying that lease payment. But here's what happens when somebody borrows money for a commercial property. I do it. I own commercial property. What happens is that you take out a loan from a bank, and these are regional banks. They keep that loan. They portfolio the loan. It's not like a home mortgage where the minute you settle, your home is already sold. A lot of times the title officers, closing officers say, here's the new bank that bought your loan. That's going to be the one you owe the servicer you're going to owe the money to. It's not who you think it is. It's this other company. That already happened. It happens in a lot of times before you even close on your house. They're sold. Banks shut down, whatever, they sell out. But the regional banks, and they hold this money, this commercial money. And a lot of times they're investors, not owner occupants. So the burger place that Drew was talking about doesn't actually own the property. He leases it. Most businesses, that's how their balance sheets are set up. They lease, they don't own. So the owner of that building is taking out a mortgage in a lot of cases, and they only get a 5 or 10-year mortgage. That's it. It balloons at the end of that. So what happened is their payments are interest and principal amortized over a greater period of time, maybe 25 years. So their payments are lower, but at the end of the 5-year period, boom, all the money, the balance is due, or the 10-year period, which we don't see anymore. They're not really doing 10-year mortgages a lot in commercial space. It's 5-year. Now what's happened is 5 years ago, you could get those mortgages for 3.5%, 4.5% in commercial. Now they're 9 and 10%. Here's the worst part. Not only is that building owner's payment significantly escalating, a lot of the banks don't even want to refinance it because it doesn't qualify anymore, because their financial statements, the people that own the buildings, are vacancies and lack of income. And so what's happening is the bank's saying, we don't even want to refinance unless you bring another $4 million in cash to the table, which the business owners don't have. This is a problem. We're not even talking about that right now. We talked about it months ago. You heard about it. You know, it was in the news that they were saying, yeah, this, you know, we were got to worry about this. We're not even addressing it. Regional banks, 70% on average of their assets are in this kind of a loan. The bank assets. They've taken your depositors' monies. They've lent out money on the commercial market. Now, the Fed has showed us where they're not going to let these banks fail. I mean, we've seen that, right? We watched that with what would have been some of the largest bank failures that we had in 2022. But let's look at this mortgage chart here, because a lot of people are calling me and they're saying, okay, the Fed's dropping rates. Do I get a better mortgage? Actually, mortgage payments went up. When the Fed announced, we actually saw a rise in mortgage rates across the board. But you're still seeing articles that are saying, well, you can get in the fives and whatever. And there probably are loan programs out there where you can get in the fives. But what I've been constantly warning people about, new home construction has been offering mid fives for a year and a half, and it hasn't helped their sales, because people can't afford the other costs that go along with it. So when we're looking at this chart here, what I want you to do is understand that along with these recessionary times, we're seeing, for the most part, declines in mortgage rates. All right. So we're seeing the same similar decline in the mortgage rate from October of 23, where, we were about, 7, almost 8% in this period of time, 7.76%, depending on your credit. We were seeing over 8% mortgages. So my point is that where we are right now, guys, really dates back, we're going back 25 years, with where we are still in mortgage rates. We're higher still than we were 25 years ago, and the asset class has continued to climb. So, Drew, what are you seeing with this chart? Are you seeing buyers all of a sudden coming out of the woodwork going, yay, they reduced the interest rates, now I can get a 5.5 or a 5-6% loan? Are you seeing those buyers just surge to the to the open houses, excuse me, and things like that?
Right now, absolutely not. I think we're seeing buyers basically sit back and say, okay, I've basically been taken on this roller coaster ride over the last couple of years, and we know that eventually it's going to go back down. So let's continue to wait until it goes back down. And, this is a real interesting thing we got going on here, Todd, because, we all know that in 2008, a lot of the mortgages that were written were basically not legit. A lot of these people were not qualified. And that's, how everything just kind of broke down, unlike anything we had ever seen before. But this time,
Drew, I could argue that they're not qualified right now.
Well, see, that's where it's tricky, Todd, because I see every single client of mine and every single basically, friend of mine that is in the mortgage loaning business, they put these people through the ringer. It is not easy to get a loan. I've not seen an easy loan.
I didn't say it was easy. I said that they can't afford them, that they're borderline shouldn't be buying them because of the affordability. Let's be clear. I think like 74% of the mortgages are actually backed by the government.
Mm-hmm. Mm-hmm. Yeah, and I will admit too, while I talked at the beginning of the show about, at the time selling my condo for what I did, now here I am living in an apartment, Todd, after I just lived in a nice condo on the beach, and I'm sitting there, I hear the footsteps above me, and I'm in this small little 900 square foot condo, which, in my, terms is little, but But I knew whenever I went to buy my home at the end of 2022, and I was watching this show religiously, I knew that the numbers that were being put in front of me was probably biting off a little bit more than I could chew. But there is that, I mean, I'm in my late 40s. Time is of the essence to me. And to me, that's my most important asset. And I just had the thinking where, you know what? I'll make the money. Let me just do this and deal with it later, because, where you live, it is one of the most important things that you're going to put your money into. I think more important than what car you drive, any other little things you spend on your kids or your wife or whoever. But I really believe that that's the most important money that you're going to spend. Where you live, where you come home to every day when you step out your front door. You want to be happy. You don't want to be in a place that you don't want to be.
Yeah, I agree. But I do want to go back to the affordability issue, because I still believe that a lot of the people that have bought houses in the last 4 or 5 years overextended themselves.
Sure.
One of the things that I know and but I deal with, certainly I talk to people all over the place, as I had mentioned before. Buyers seem to always, and this includes loan officers, buyers always seem to buy at the top of their affordability. Mm-hmm. So what happens is, and this is an issue, because we're motivated by commissions in our industry. I mean, that is a fact, right? It's the same thing that would happen in the car business back in the day, right? If you bought a car 30 years ago or 35 years ago, they whacked you, man, in the finance department, right? And people got paid on that. The salespeople would get paid on that. They could sell you that car at astronomical numbers. They whacked you on financing. They basically just buried you in the car, right? And what happened was their industry got torn apart. Now, we saw craziness happen during the pandemic when no inventory was out there. But look what happened to the car business. It got flattened like a pancake, right? They went to internet sales, and people shopped. They could look at inventory. They could see costs. They could negotiate it down. They knew that the dealerships had holdback money and advertising money and all these different things, right? They tore it apart. So what happens is now we're in an industry where everybody's got their hands out, and I get it. Everybody needs to eat. I'm not saying that, but it's wake up time now, right? I mean, this is history's, forget it. We're moving forward. What happened was our industry, there is no question about it in my mind. In my opinion, our industry was fueling this asset takeoff, right? So what happens? The buyers are coming, and a lot of these buyers, and I'm talking about first-time buyers, a third of the buyers for the last 10 years, man. We're talking about buyers, first-time buyers represent, I think there's 74 million millennials in the U.S. I think there's 69 million Gen Zs, and I think the Generation Alpha is about 50 million alive right now today that have been born, okay, and that's going to just continue to blossom because of the age gap that they will create for that Generation Alpha. But when you look at it, it's no question why, they were the first time buyers, and that was a third of the buyers in the market, right? So what happens? You've never bought a house before. You go to your buddy who's a loan officer. They're a dime a dozen, just like agents. And all of a sudden they go, well, yeah, man, I can qualify you for a $550,000 house. And these young people are like, all right. So they go to the agent and they're like, well, what are you qualified for? Well, I'm qualified for 550. Well, great. Well, let's look at the 560, 570, because maybe we can negotiate. Maybe we could get it down, or they get this taste of it. They're like, well, so now what do? They buy at the top of the market. They buy at the 550. Now what happens? You just told me the condo fees in a couple year period doubled. That's unaffordability. That's taking somebody instantly expecting that they're going to get a 50% increase in their pay to be able to pay increasing taxes, increasing insurance, increasing condo and HOA fees, increasing cost of repairs.
Yes.
We can't forget about that. A house falls apart.
Yeah.
If you live in the house, chances are you're going to need to spend money. We're not educating people enough on that. We're not telling people, look, dude, you can't afford this. Well, I can't afford it. The loan officer said I can afford it. My job, I'm going to get raises. What if you don't?
Yep.
What if one of you lose your job? You're an instant default.
That tax
And we know that.
Yeah, that tax reassessment too is something that
we know it.
Yeah.
We know it's happening because of credit card delinquencies. We know it's happening because of auto loan delinquencies. You're not hearing it, but we know it's happening, right? So that's how I know it's unaffordable. I look at the sales prices of these houses. I know what median, salaries are, incomes, household incomes. I talk to people every single day that want to buy a house, but they can't afford it. Right? So I question the affordability. I'm not coming down on you. I don't have the sentiments that these people, they can afford it. I personally know young people, millennials and Gen Zs that bought a home, and they have called me and said, oh my gosh, we can't afford this. My job is laying off. I'm scared to death. We just had one of our viewers call up and say they lost their job. We're going to help them out. They're in Maryland. We're going to help them out. We're going to stick by their side. We're going to help them, close the chapter that they feel uncomfortable with right now. And that's what people need to wake up. You got to wake up. And I'm not trying to get people to sell their houses. These are realities, man. These are realities. And people need to let people know that these are options for them. Don't wait. Don't wait until the knock comes on the door or you're in foreclosure. I have one right now. My agent is going to see somebody that is in the middle of a potential short sale. They have modifications. They are we got to work through it. So this is real life stuff that's happening out here, and but I do want to move on. Because I do want to get to the meat and potatoes of, what we're seeing in the housing market. But I want to stay on right now. TJ said nobody calls me. Why do you listen to me? I'm just kind of curious, TJ. Your comments are never good. I'm just kind of curious. I just think you like to come on here and give me a hard time. Anyway, I love you anyway, but it just amazes me sometimes. Like, if misery is that bad, if things are what I'm saying are affecting you in such that way, I'm just kind of curious why you show up every week. Anyway, let's look at this one. S&P 500. You're laughing at me now. At least you have a sense of humor. S&P 500. This is another asset class that we want to talk about because the bubble is not just in housing. I was just talking with, Adam Taggart. We recorded a show, and Adam's bright. He's one of the brightest minds. And by the way, I do want to, I want to plug him. I don't know, Joe, if we have a link or whatever, but in the show notes, Adam has an online conference that I want to kind of promote for him right now. We're going to put, a link in either the comments after the show or in the show notes. But Adam, he's a bright guy, Ivy League education, worked on Wall Street, worked at Yahoo Finance. He was a head of marketing at Yahoo Finance, and just a really smart guy. He has a YouTube channel called Thoughtful Money. We have something that's getting ready to come out. I don't know, maybe this Thursday night. I think it is. Is that what it is? Thursday night at 6:30. Yep. And there's his channel there. And the reason I'm plugging him is because him and I have been talking a lot about the stock market. And when we look at the housing market and the inflation that we've seen, if you bought a house in 2003, before the GFC, and then you went through the GFC and you had some kind of a downturn, all of the gain that we saw these homeowners make through that 5-year period from 2003 to 2008 was completely stripped away, right? 5 years back, we set back in the GFC. And, a lot of people, it took until 2022 before they could sell their home for what they paid for it at the peak of 2006. This is a fact. And so when we look at that period of time, if you had to sell, you maybe had to bring money to the table for a very long period of time. If we went back 5 years today, that would mean a 50 to 80% home price correction in the housing market. That's massive. Can you imagine that? Can you imagine if we went even halfway back? We didn't go back to 2019, but we went back to 2021 prices with any kind of a dip. Now, we're not prepared for that. The stock market's not prepared for that. The housing market's not prepared for that. And the reason is because since World War II, we never saw a price correction in the housing market until 2008. We saw some ups and downs depending on, we know in June, you're selling your house for less historically than you sold it in March and April and May. So if you didn't sell it by June, we knew you got into that cyclical market where you dealt with vacations, homeowners, or home buyers, going on vacation. Then they come home to back to school, then the holiday season. So the spring historically has been the best time to sell a house. So we did see up and down fluctuation, but we never saw a dip in asset prices. People like Dave Ramsey say, well, you only see that once in a lifetime. Well, we'll see about that. But when we look at the stock market, when Adam and I were talking, I said, Adam, what would happen to the stock market if we had a 5-year correction? And he said, oh my gosh, it'd be devastating. He's like, that would be awful. It'd be like, maybe not as bad as the Great Depression, but it would be awful. And I said, you know what, Adam, I think it'd be worse than the Great Depression. And the reason is because in the Great Depression, there were still a lot of houses that didn't have electricity. We farmed, we made things, we were a community, we had outhouses in the backyard. We went out and took a crap in the middle of the night when it was freezing cold outside, right? We didn't have a lot of the amenities that we have today. So now a massive wealth correction would mean a lot of people just wouldn't know what to do. They don't have chickens and cows and skills and things like that. So, but we were looking at this chart here. This is the S&P 500. And just look at this run up. Can you imagine? I mean, here we go right here. Just in 2023 alone, even if we go back to 2023 here, I mean, look at the run up. We would not need to go back very far for a 25 or 30% correction. Now, the big thing here is housing is like 35% of GDP because you have all the housing related costs. When you have a house, you own a house, you buy more stuff at the store. You may overspend, you end up throwing stuff away that goes bad. We buy junk that we accumulate, we throw it in closets. Maybe we're not going to buy that if we don't have houses and we're living in RVs. We're pushing people to RVs. But I just wanted to show this. If we look, there's going to be a great podcast on Thursday night. Adam is not saying that we're going to have, this, 50 or 60, 80% price correction in the stock market, but he definitely is interviewing people that are saying it's coming. We're going to see something, a correction. Now, the nice part about Adam is that he tries to help people and, invest in whatever and prepare for whatever. So anyway, he's a buddy of mine. He's worth checking out and cruising over and seeing. Drew, you got to have any input here, man?
Oh man.
It's a lot to unpack.
Yeah, it is a lot to unpack. I think a lot of this run up, you say it's just, a lot of it's based on AI right now. This NVIDIA stock has just been incredible over the last 2 decades. And, just like for so long, Tesla was such a big part of the run up, say 4 or 5 years ago. And, it just seems like those few companies that are just driving everything right now. Overall, I'd say that, signs are definitely there of something, just over the hill here, possibly a correction.
All right, let's move on because one of the things I want to look at here is I want to get into the housing market data. You know what? Before we do that, let's take some comments. Let's see what we got on the comment side. If you guys have anything for Drew, now's the time. You want to know something about Florida, Clearwater, or even the surrounding area all the way to through Seminole, I'm sure, and into Tampa, and that covers a pretty large coast, but it's a quick drive for Drew to be able to get up there. If you're in Florida, maybe you're looking and you're one of the ones that you're seeing the market decline, and you want to talk about price. Drew's not gonna pressure you, so I would highly encourage you to reach out to him. And if he does pressure you, I expect you to let me know.
I will say, Todd, that this comment right here from Kari, fully funded reserves, when Kari is asking me to explain what the condo reserves means. So that's fully funded. So after the collapse of the condo in South Florida, a lot of these laws were put into place. So now there is discussion. Did they go too extreme on these laws? Because right now you have a lot of older folks, okay, and even some of these 55 and older condos that cannot afford these HOAs. So Governor Ron DeSantis, who has been, I think, for the most part, a successful governor here in the Sunshine State, but there's two things that I think have really bit him during his tenure. One is insurance, and two, these condo laws. So he's now calling for special sessions to try and get this right. How much will it soften the blow? Because obviously there's a major problem right now going on that needs to be corrected, and it's causing widespread panic, not just for people to just live, Todd, and get out of bed every morning, but for folks that want to sell as well. Those values are plummeting right now big time because those HOA fees are so high.
Yeah, great question. All right, let's see what else we got here. Eddie says, it does seem like every effort is directed toward maintaining the bubble. Case in point is the 0.5 rate cut at stock market all-time high. And, I mean, look, that's a big cut. A lot of people don't think it is for the Fed to come off of a higher for longer policy and make such a drastic statement in the market. I think that if I were to read it, I think this is, in the question, and I think we want to get ready and pull up that poll here, but I think if I were to read what is going on, I don't know. It may be some political pressure. I don't know. The Fed has said before, I saw a 2020 interview where they asked him, hey, is there any political pressure? And he said, no, we don't buckle to the political pressure. We have a job to do and a policy mandate, and that is price stability, that we've heard it a million times. And then also to keep, watch wage unemployment and the inflation. Well, my question is, when all of this inflation was happening prior to the rate cuts in 22, why didn't we cut the rates a year earlier? Certainly above my pay grade, but it's interesting, right? And then Jay Powell also testified that the banking industry was solvent, and then shortly after that, we learned that Silicon Valley was imploding, and a couple other banks as well. We're not really hearing anything about that now, but that would have been like massive. All right, so here's our poll: 554 votes. Fed cuts rates 0.5%. This shows what? 64% of you say that the Fed knows that it's about to hit the fan. 27% of you say political pressure. 6% inflation is under control. I guess you guys have, a lot of money, and consumers are ready to spend money. Only 3% of that. And I don't think consumers are ready to spend money at all. But let's go ahead before we dive into what we're going to cover with the housing market, the current market, and sort of what we're seeing in prices and demand. Let's go ahead and take some more questions. Uncanny how much the beginning of this century is mimicking the beginning of the last century. You're 100% right. History does repeat itself. That's why I find it hard to believe that we won't see some kind of a massive downturn. Thanks for the comment. Prices are going down, Ryan says, down in Florida and Texas, but can we ever realistically expect prices to come down in Los Angeles, where there will always be more demand than supply? And, the supply is, there's a lot of truth to the supply side, because who controls that? There are, tons and tons of regulations in order to bring a housing community out of the ground. And, we talk about affordable housing. A lot of the mandates, or what I see with affordable housing, it's not really practical, and it's not affordable at all. It comes at a very high cost. And, now we're really with the green energy stuff. I mean, it's really making things expensive. So, I think that if you take a product and you can control that product and prevent landowners from doing certain things with their land, not only are you taking property rights from people by not allowing them to do what they need to do with their property, you're basically controlling the market. So who's paying the taxes on the property? Who paid for the property? Who's paying for the upkeep of the property? Who's paying the property taxes on the property? Who's keeping insurance companies in business because of the properties? And then all of a sudden you want to do something like build, or subdivide your land, and you can't. They put these, zoning, restrictions on properties, and it's not all the government's fault. It's really not. It's the people too. Because believe me, I've gone to enough hearings or public impact meetings where, a developer wants to come in. They almost have to lie about who they are. They just say undisclosed, whatever, until a certain point. Then they have to disclose who they are and what their plans are. But they're just trying to change zoning or get something approved to build more housing. They have to go through pure hell to actually do that. And what happens is, it's not just the government regulations, but the people show up at these impact meetings, man, and they scream and kick and fight. I went to one this year, and they were trying to take a old military base and develop it into housing and, bring more people into the communities to support the businesses. Man, they went nuts. Yeah, I heard people saying things like, well, you've got foxes and raccoons that need to, live on this land, and where are they going? They're going to push them out. And the people went nuts. And so a lot of that is what happens. People also stand in line to say, hey, I want affordable housing. But the minute it comes into their community, they're like, oh, no. I want affordable housing, but I don't want you to do it here, right? That's what happens. So, we have a system that's broken. Now it can be overridden. You could come in and say, you know what, guys, we're going to bust this up. We need more housing. We're going to clear some land, go up in a helicopter and airplane. You see, we have plenty of it. And we're going to do some things here and loosen this up. But the idea is, let's put people in sheds. Let's build accessory dwelling units that are, in the backyards of, and call them tiny house communities, right? And we're going to put our elderly people in it. That's a great idea. We're going to make a tiny house community for our elderly, and they're going to have to put their furniture away and unfold it and buy, and we're going to stick them here. And, so you look at these things, and it's absolutely preposterous, in my opinion, on what we're doing. What is going on with people, man? It's like insanity at the, just off the chart insanity here. What we need is affordable housing. We need to incentivize builders and developers to build 1,400, 1,600 square foot houses. We need to open up the ability for these developers to do it, incentivize them, and let's get this thing under control. It would actually help the counties because they'd actually have more houses to bankroll. But we want to stack the people. We want to put them in buildings. We want to put them in condo regimes. We think this is a great idea. We're going to take an apartment complex and convert it so that we can, get more stackable revenue. Because if you think about it, that 5-story building or a 5th floor that Drew was talking about, each owner pays property taxes. So now you take those 4 towers or 5 towers he's talking about, add that up. Now you're talking about big revenue. So you kind of opened it up there with, will we see more housing supply? Well, that's a great question, right? Question for Drew. Here you go. How is public schools funded in Florida? Property taxes or state sales taxes?
Thanks, Charlton, for the question. Property taxes fund public schools, and that has been a huge topic of conversation. Right now you got a lot of things going on in the Tampa Bay area. In Hillsborough County, which is where Tampa is, there is a major shortage right now. Number one, finding good teachers, qualified teachers that will work for that pay. And the other is just funding. Right now it is so low. Todd, I spent a lot of times in the media, long time in the media before I got into real estate, and I would see so many coaches, young men that love sports, get into coaching. They said it was their lifelong dream, and then I kid you not, a year, 2 years later, resigning for family reasons. What does that mean? They just didn't make enough money, and the county could not find enough money through the property taxes to compensate, all of these positions, which caused, so much of a time dedication. And then there's also things, let me just throw this out there. Tampa's a big time entertainment community. Right now, the Tampa Bay Rays, the baseball team, is looking for a new baseball park. And, where's that money going to come from? Right now, it's been a hot topic of conversation, but the locals in St. Pete do not want to pay for this, do not want that, to go into their taxes whatsoever. And of course, the owners of the team, they're trying to get help from the public. They're willing to chip in, but only so much. But just to answer,
how much do these players make?
Well, the Tampa Bay Rays is actually, to kind of put it in your terms, kind of like the Pittsburgh Steelers of Major League Baseball. So they're probably the lowest paying. Usually players for the Rays, they come to Tampa Bay, they'll play for 5-6 years, and then at the peak of their career, the owner of the Rays will say, "Thank you very much for your time. Go sign that big contract with the Yankees or with the
Dodgers. How much do they make?
Because we're not going to pay you." I'd say Rays players, will max out maybe in the single digits per year, meaning 8-9 million, something along that line.
When 8 or 9 million a year.
Yeah, for play.
Make them pay for it.
Yeah, exactly. Yeah. So,
I mean, this is, what? I went to a ball game not that long ago. My buddy called me up and he said, "Look, I got some tickets," and they were really good seats. And, we were basically, at the first baseline, basically on the diamond. I mean, it was, a couple rows off the turf. And, besides watching these players come out, man, they were so arrogant. I mean, stretching and doing their, not my thing, man. And, and people were, and they're looking, giving the cool thumbs up and stuff. And I'm like, man, I started looking up some of their pay. And I'm like, are you freaking kidding me? I mean, look, it's not, you spend $19 for a hot dog. I don't know what it was. I spent a fortune, a hot dog and, a couple of drinks. And man, I tell you what, I was like, by the 6th inning, I was done. Now, I'm not knocking the people that love baseball. It's your thing, man, whatever. But we are so off base with what and we pay teachers how much? Mm-hmm. I mean, the teachers are going out and buying their own school supplies. Mm-hmm. I know a teacher that goes out and that buys the kids clothes in the school system. I mean, are you kidding me? Like, what is really going on? Now we're going to take people that have lived in an area, their retirement age, we're going to whack them and say, this is what we're putting here to pay these people $9 million a year. No. Mm-hmm. No.
It was done once with the Tampa Bay Buccaneers stadium back in the mid-'90s. That's how their new stadium was basically put into effect. But I don't think something like that's going to happen again, Todd. And I think you're right. There's a major reality check coming with some of these professional sports. We've heard the Tampa Bay Lightning, which is one of the most successful franchises in sports. The owner of the Lightning, the guy who basically rebuilt downtown Tampa, recently just put a big share of the franchise up for sale. So he's basically now sharing it and kind of cashing out while he can. The Boston Celtics, one of the most iconic franchises in sports, they're for sale right now. I know Jeff Bezos is trying to get a deal on them, but these franchises, these sports franchises, and just where's that money being passed down? The networks, or obviously the TV deals are making this happen. But now you've got the battle for cable, and as a consumer, are you going to pay 5 different streaming services to basically just watch a ball game on a Sunday?
You have to. You have to.
Yeah.
I mean, that's the ridiculous part, right? You have to.
Yeah, it's gotten completely out of control, and the person who they're not thinking about is the customer, the consumer. And eventually, Todd, the rubber's going to hit the road on that one.
And this just goes on and on and on. We could talk for hours about this. I mean, trying to get a hold of companies anymore. You have to listen to 5 or 10 minutes of this. If you're calling for this, press, but I mean, come on, man. We don't even think about the client anymore. No. All right, what else we got? Some more questions here? I know that we had Joe, do we have our, oh yeah, by the way, getting back to the property taxes just for a minute, I interviewed a guy, Mitch, a couple of weeks ago, 2 Saturdays ago. He's in Texas. He's talking about property tax fraud and, how, he's dealing with it. He's got a lawsuit going. I've had more people that have reached out, and there it is right there. More people that have reached out and said, hey, I can tell you this story about my property taxes, and it's like, how do they come up with these property taxes? And so that's a great video if you care to watch it. All right, more questions here. Hey Todd, do you think that inflation can occur so quickly that home prices cannot come down? And like looking at the chart before, I don't see how they can't come down. I just don't see it. I mean, what we're seeing right now is houses, and I don't know how to say this other than just say it. I think what's happening is that in a lot of cases, the agents are keeping this market, stoked with the cheerleading. I don't think that we're getting, the desperation is just you could smell it in the deals and the conversations, just like Drew had said it earlier. If you are a buyer or seller right now, you have to be so careful. You have to sniff it out, man. I'm going to tell you a story about what I just experienced, with a buyer, and looking at properties for 6 months. Found a property, put an offer in. We weren't told about a significant material fact on the property. Material facts is something that an agent knows that could harm the buyer physically or financially. They have that knowledge. When an agent is licensed, you are required, no matter who you serve, to talk about material facts, disclose them, even when your client doesn't want you to. And, this recent, it was a big deal. We're talking about violations and a hearing date, violations on an HOA and a hearing date that wasn't disclosed until after the contract offer was submitted. And so what happened is, hey, this is a big deal. We're not just talking about a couple things. Not just that, but when an agent is telling you that they have multiple offers, you got to sniff that out too. Because, I had a situation where I'm like, well, let's see it. No proof. You got to show us. You got to tell us something. My buyers want to know. You can't just bump it up with an escalation clause because, my buyers, $10,000 or more lower than what you're telling me they have to spend. Where's the proof? So guys, you have to be ultra sensitive right now if you're a buyer or seller, and you gotta cut the grass to see the snakes. And I'm just telling you, that's a fact. When we are in a commission environment, in any industry, and you start to see the money get extracted from people, desperate times call for desperate measures. And you start to see where people are like, man, this is my job. I just had one of our agents, basically say, I can't believe, what you're coming out with. And you're saying, not my agent, but one of our referral agents say, oh, why would anybody buy a house if they listen to you? Look, we got people that are buying houses with me. I have people selling houses with me. We're just talking about what we see. I'm not telling you don't buy a house, don't sell a house, or sell a house. What I'm giving is advice, which I am entitled to do and required to do as a licensee for my clients, right? But this agent said, you know what? Why would anybody ever buy real estate listening to you? Get a freaking clue, dude. Why don't you face the music and identify the fact that people are tired of cheerleading? We got a whole world of it. It's no secret that people don't hold real estate agents in high regard. Drew, do you realize that? Is that a shock to you?
100%. Every time I go into a situation with a client, I treat them like they're a family member, a relative. Like I treat them, not one time will I tell them, hey, listen, we really need to do this. I will not push them or nudge them to do anything. Now, if they tell me, listen, I really want this property, what do I have to do to get it? Then I have no choice. I had a situation
Agreed.
last week where there was a really, really unique home. This home, you walked into it, Todd, and it felt like the Brady Bunch house. It was a really just unique late 70s kind of feel, but really, really cool. Had a beautiful pool inside it. The home needed to be, definitely needed some improvements. It needed some TLC, but it was a really unique property in an outstanding neighborhood. That was priced at about 1.1 million. Well, buyers walking in, touring it with me, saying, well, I'm going to get this property for 800,000. And I looked at them and I'm like, no, you're not. It's, that's not going to. Now, do I think it should be worth that, or, that should be the price? Yes. But do I think that we can get this under contract at that? No, it's not going to happen. So I'll tell them sometimes what they don't want to hear. But never will I try and tell them to pay more than what they're willing to pay. But I will tell them, hey, if you want this property, this is where I think we have to be. And I also just try and get that absolute lowest number that we could potentially get it at. But
what I've been telling people, and that's I mean, you're spot on. What I've been telling people, Drew, is I say, look, if we're looking at the house and we're trying to evaluate the comps, and the comps are hard because there hasn't been a lot of sales. So when you're looking at comparable sales in the subdivision, and that's really what you want, the best comps are in that immediate subdivision. You have to look at the subdivision. If an agent's showing you comparables, look at the subdivision and see what that subdivision says. If it's a different subdivision, it's not a comp. So what happens is it's becoming more difficult. You've got to go back a little bit, but you also have to do things like tour other available properties so that you can get a visual of what the other competition is, not just look at the pictures online. But what I tell people is this: we try and strategize. And I say, look, we try and come up with an offer that we think, and it depends on them. I mean, if they really want the property, I have to tell them, you may be overpaying $20,000 here. So look at it from that lens. When you're, if that bothers you, maybe you need to reconsider. If you're like, you know what, if it drops another $20,000, I'd still be fine. I wouldn't care. It's a lifestyle and it's something that I want and I can afford it. Then you know what? Full speed ahead. I'm not telling people don't buy, but it is my right and my obligation to tell people what I personally think. Mm-hmm. And I'm consistent with that. I've not swayed off of, people say, oh, he's been calling for a housing crash for 5 years. I haven't even been podcasting for barely 5 years. I mean, give me a break, right? People say things like this. I've been calling since the spring of 2022, okay? If you think the market's hard to time, or don't think it's hard to time, it is hard to time when you have these other forces out there like stimulus, like loan mods preventing foreclosures and, other things that are happening, right? Where you're taking out actual debt from qualified buyers being qualified, like their student debt. And, you're doing all these other things like, creative rates and buying down, mortgage rates if it's a new construction. But not just that, but think about it. We have crashed since 2022. We have crashed because you know what? Home inspections are back. Appraisal gap contingencies are next to none. Now, every market's specific, but I'm talking about for the most part, and I keep my pulse on this pretty far. We're seeing 30, 40% price reductions of active inventory. That's the metric, folks. If you're looking at metrics that are median priced homes, we're going to look at some charts, but you're looking at that is so manipulated. And I'm not saying intentionally manipulated. It's manipulated because only the wealthy people have been buying. The cash buyers have been buying. And if the price of the home goes up because that's who's buying and the sales go down, your median price is going up. So you have to study the data. You have to look at the data. You just can't be ignorant to it. But we know what we're seeing is increase in inventory that we have not seen in a long time, pre-pandemic inventory levels. Okay. So, and when we were in 2019 going through getting ready for a major recession, I believe back in 2019, we're seeing that number in inventory right now. We're seeing numbers rise, and we're seeing actually people starting to take their homes off of the market because they're not happy with them sitting. So they're like, you know what, I'm going to curb it. We'll hit the spring market. So when you look at those facts alone, buyers, you're not having investors bidding like you did pre-22. You're not seeing those investors coming out of the woodwork because the numbers don't work. Give me a break. You've got 3 tiers of buyers. You got the bottom feeders who are the flippers and the rehabbers. And I'm not picking on them saying they're bottom feeders, but they're bottom feeders because they need a profit. They're gonna go an instant profit on that property. They're not holding it long term. They're gonna buy the property. They want to buy it cheap. They want to put money into it. They want to put their lipstick on the pig, and a lot of times, and they want to just offload that property for the next sucker that comes along and buys it. Right? Not all the time, but a lot of the cases, right? I've seen a lot of junk out there. That investor's gone away. They're gone away because they're like, I can't make a profit. I got to pay too much, because the next buyer comes in is the investor long-term hold guy. They're buying it for future income. So they're saying, you know what? I'm going to buy this today. I'm going to pay more than a flipper can, but I'm going to buy this today because I'm going for the long-term income. I want to put a tenant in there. And even if I break even, which is stupid, and I hold this thing long enough, hopefully rents are going to continue to rise, which they're not for a long time. And those are the next buyer, and they're out of the market. They've gone away, especially in the single-family home community, because they're like, I can't make any money. Right? The 1% rule that they want to live by, most of the investors are like, okay, well, if I pay $400,000 for the property, I need to rent it for $4,000 a month. Well, that's risky, because you're not going to get that in a lot of cases. The next tier are homeowners. Hello. Right now, they don't have the competition that they had pre-2022 with the investors at a third of the buyers. These iBuyer programs that have gone bust, lost millions of dollars, Zillow offers. I mean, guys, they were letting sellers pick their move-out date. I'll tell you what, I just want to buy your house. We're going to pay you today. And how long you want to stay? A year? Rent-free. No problem. Just turn your deed over to us. Here's the check. Well, they found out that was stupid because their own Zestimate crashed and cost them a lot. And cost their shareholders a lot of money. You don't believe me? Google it. You could see what I'm talking about. So this is what was going on. Those people, guys, are gone. We're now seeing hedge funds looking, they're going, we might need some money. We're going to have to sell some of these properties. They got spanked. A lot of these people got spanked because we were so creative that we prevented people. They didn't need to pay the rent. Imagine that. You're a mom and pop landlord. You bought a house. And now all of a sudden your tenant doesn't have to pay you, and you can't throw them out. And then when you can throw them out, the courts are so backed up, it's going to take you a year, depending on which state you're in, maybe even longer if you're in Hawaii. Right? So this is the sanity. If we're going to talk about, and we're going to negate what I'm saying here, and we're just going to poo-poo it and say, he's just calling for a housing market crash and he's wrong, look at the facts and tell me whether those things are happening today. Were they sustainable? No. Well, it jacked the prices up, so are those prices sustainable? The answer is no, unless people make a boat ton more money in their wages. Again, is that sustainable? Do you really think that's going to happen? When your employer is looking at you saying, I don't know what we're doing today. We're slow. And you're going, oh, please, 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 pass me. Don't select me to be laid off. I just bought a house. We have to be realistic, guys. I'm not trying to sell doom and gloom. I'm just saying that we need to wake up. We need to get our act together. We need to stop our excessive spending, our ignorance to where we are, and look at your pocket. Look at your bank account. All right, I want to look at some things here because I do want to cover it before we get out of here. I want to go over some of these charts. I don't know. I may have messed this up. Or yeah, let me expand this a little bit. I'm getting better with my technology, man. I'm really just surprised at myself that I'm learning like AI. I mean, man, you go figure that, man. I'm telling you what. I'm complaining about AI and the potential that it could take our jobs away, and I'm trying to embrace it and learn it and say, how can I do things? And, because here's what happens. Number one, we're getting to a point that we can't find the truth on the internet. And I think that's going to get worse. My gosh, all this machine learning, we teach it a bunch of wrong stuff, and all of a sudden we don't even know history. And I'm going to tell you something. I actually thought about this the other night. It was like an epiphany, right? I woke up in the middle of the night, and out of my brain came encyclopedias. I was thinking to myself, I remember, now, you guys may not know this. I have talked about it before on my show, but when I was a kid in high school, in the summertime, for one summer, I sold encyclopedias. Now, a lot of people are going to be like, what the heck is an encyclopedia? Well, Wikipedia? You mean you sold a Wikipedia? They were books that had history in them. In fact, my grandmother would medically diagnose anyone with an encyclopedia, and she did not have any kind of degree. She was not a clinician or a doctor of any sort, a nurse even. She was just smart. That's right. And she would use the encyclopedia to diagnose things. God love that woman, man. I'll tell you what, she was very dear to my heart. And yeah. Anyway, I got up in the middle of the night and I thought, encyclopedias, man, I need to go out and start buying encyclopedias. Because I think that in a period of time, we're going to wish we had those. Because people are going to hunger for the truth, and they're not going to be able to find it. We're destroying our history, right? But anyway, this AI, it's interesting because now, when I'm trying to figure out what's trending or what are people really looking for, I had to spend like hours online or hours on Twitter. And now I can just put a model into Chat GPT and it will tell me what has more than 5 million views or what has more than 5 million likes on something. What's the most trending thing? And it's amazing that you can do that so fast and run it through like 3 or 4 different models and have the results that you could even search, and it's pretty solid. You got to manipulate it a little bit, and teach it. But anyway, the data is going to be very valuable maybe one day if you're going to care to explore it. But I want to just go over some charts here because I want to get back into the sustainability of where we are right now. And I want to put this into some kind of perspective for you because a lot of times we lose perspective. So here we go. This is the great financial or global financial crisis, the GFC. And what we're looking at here is average sales price of houses sold in the United States. We're looking at the S&P CoreLogic Case-Shiller index, and we're looking at median sales prices. Now, do I need to tell you guys what average and median means? Median is the middle. So it's, the middle between what's sold less than that or sold more than that. Average is you take all the sales together, you divide it by add that all up, and then divide it by the number of sales, and that's your average. So when we look at it, there is a little separation in the chart, but it's indisputable that they pretty much go along with each other. So whatever average, median, price index, however you want to summarize it, you can see back here in the day, homes used to be affordable. In fact, many people only had one income and they actually could afford to raise a family of more than one. on a single income. They could still afford a house. In fact, this is the era that I grew up in. And a lot of my friends, their parents are still living in those houses today. There weren't starter homes. They were home and a place where they laid down their roots, invested in their community, and, raised kids. We started to see something phenomenal happening. And, certainly way before the industrial, revolution, we started seeing around this point in 75, like I said, we started shipping our jobs offshore and we started doing smart jobs. Well, at the same time that we were doing that, we're seeing that home prices were starting to massively appreciate. So we weren't talking about blue collar jobs. We weren't talking about factory jobs, where we worked hard and, earned pensions and retired at companies. We went into this frenzy period to where we didn't really care about the life's principles so much. We just cared about being consumers, spending money. That's what Americans are. This is about the time when we were taught that we are consumers. No matter what you go to college for, no matter what job you get, we are consumers. We're going to buy the next best thing. And we're going to continue to do that even when we don't need it. We're going to have more shoes than we need, more shirts than we need, more clothes than we need, better cars than we need. And that's when we started to become unhinged as prices started to really peak higher than they ever have in the history. Just to give you some context, pre-World War II, the average mortgage for a home was 5 to 6 years. And basically it was an interest-only loan. You had a balloon payment at the end. You had to put 50% down. Now, people could question back then, were we better off as a society than we are now? I mean, that's the question. I didn't live back then, but I did live through the 70s and the 80s, and I feel that we had it better back then than what we have it now with a lot less technology. We actually did things like bounce the ball off the wall, had conversations, went out and, we had swings underneath the trees. We don't even have, you see empty playgrounds nowadays. They took things away like seesaws. They said that they were too dangerous. We love seesaws. But, oh no, you could get hurt on a seesaw. Right around this point, we started seeing the inflation of the asset class of housing. With that, we watched houses become bigger, more expensive, and we hit what back then was the most notable bubble. They've actually flattened this out a little bit. But the most notable bubble, the housing bubble, where in 2006, housing became this asset class that people were trading. There was no longer a home. HGTV had hit a plateau. They were showing where you could profit off of houses. We were encouraging and selling courses and books and investors, getting them to buy houses and invest in houses. And as the stock market was shaky, we watched our neighbors jump into the housing market with everything that they had. As Drew had said, unaffordability. They could not afford the loans. They were buying 2 and 3 houses. They were turning houses for dollars. We got away from the American dream. We made it a profit center. Well, what happened is when that hit, we didn't have Wall Street involved in single-family housing yet. Wall Street was doing what they did best. They were investing in apartment buildings. They were big operators. They had management companies. They had staff. What happened was when we went through the GFC during the Obama administration, we had major blight in the neighborhoods. We had grass growing out of control. We had fences falling down, houses falling apart, foreclosures, massive scale. Well, one of the things we did was we sold them off to Wall Street to become investors in single family houses. So now we got away from the mom and pops. We got away from the rehabbers and the flippers. We now cast it into a new buyer that had unlimited funds of cash and could borrow money cheaper than anybody. They could raise money, from investors. Well, they bought these houses with the understanding that they had to hold these houses for a period of time and rent them to the people that lost them during the foreclosure. So when we were talking about bailouts, I mean, hindsight's kind of 2020. Maybe we were just better off bailing out the people that were losing their houses, because what we did is we fueled the market even more. And by the time we hit 2013, all right, we started inflating this asset class called housing like never before. We dropped interest rates to all-time lows. We just let it soar up. We let investors buy and build, and capitalism in this market run rampant with investor money. And investors, I think, make up about 10% of the population. So the rich are getting richer. Meanwhile, the working class people are now finding themselves unable to afford the home that they live in, because now all the other prices are coming up. And then a phenomenon happened. As soon as we kind of leveled out here and we saw, okay, well, affordability is kind of getting weak, and it leveled out from this period of time from 2017 to the first quarter of 2020. You see that? We got to a point where like, up, brakes are on. We're in the middle of a recession. Affordability's looking bad. We get into the pandemic. We fuel this puppy. We print more money in 2 years than we do in 200 years. And look what happens to the asset class of homes. Now, you could say that affordability is there, but there's argument to say that the cheap mortgage that the people bought, and people say it all the time, but they got so much equity in their home, but they bought a house that is a depreciating asset that's actually falling apart. Nobody bought with the expectation that they were going to have to put a $30,000 roof on their house, put a $25,000 or $30,000 septic system in, drill a $25,000 or $30,000 well if their well went dry or ran out of water. You know, put a $25,000 heating and air system in, just changing the outside and inside unit. It goes on and on and on. Spend $100,000 on a kitchen renovation, $25,000 or $30,000 on a powder room. I mean, guys, we're looking at this as that the inflation is so drastic and so real that I believe the cost of repairs and maintenance in its entirety, its own self, will be what drives home prices down. Because what we're going to see is, as this thing doesn't, in my opinion, we'll see if it works. I don't think it will. I'll be the first to admit if I'm wrong. But I think what we're going to see is we're going to see that these costs of repairs, buyers are going to be walking in. A third of the buyers, remember what I said, 74 million millennials, 69 million Gen Zs are now buying houses, you know, getting into that age group. And there's 50 million now of alphas. This is going to be the next third of our home buyers moving forward. How are they going to make the money? How are they going to have the money to buy the asset class of a house right now? And we need home ownership. We need people to invest in communities. So I think for these reasons alone, until we see wage growth catch up, I think it's fair to say we're either going to go through a period of stagflation and a period of houses deteriorating fast because the people can't afford to fix them up. And I think we're 12 or 18 month period away from seeing a real wrecking ball.
Todd, I think the most demoralizing thing about all this in the time that all this has gone on, watching the $175,000 two or small 3-bedroom house become a $450,000 house, that entry-level home become out of reach, because that's the home that you think. Whenever I entertain clients and they say, Drew, I really want to buy a house. I'm 35 years old. I've been saving for the last 10 years and I've got this much down payment, and they still can't get into that entry level home. That's when you know there is a serious problem going on. And, as far as, what to look for and everything, like you were saying, I can't tell you the amount of homes that need new roofs that are being put up on the market. And, kitchens as well, but the roof is the main thing. It's the most important thing, the most important quality of a home, and probably the most, expensive repair or item that must be intact on a home. So that's something to really watch out for. But that has been the most demoralizing thing. Those folks that have done everything right and yet still 1+1 doesn't equal 2 with them. And because of that, they just want to own something. Then we have to say, well, maybe we can try and get into this little condo over here. Let's see if we can find something that doesn't have a crazy HOA or, isn't by the water, isn't an investment property. That's been the most frustrating thing.
Yeah, and when you talk about those 150 or 160,000 or $130,000 houses not that long ago, when you look at their 400, 500,000 today, like you said, they need work.
Yes.
They need work. I mean, you walk into the house and you're like, whoa, man. I had this one, my clients, they've been looking for one set of clients that I have. We've been shopping for about 6 months. And, a lot of disappointment out there. And, you're trying to manage emotions. This is what we do in the residential side of things. People think, all agents are bad. They're not. They're very good at what they do, and they're necessary, because a good agent is going to manage emotions more than anything else, trying to calm the emotions. I've had people that have apologized to me after settlement. They're like, man, you know what? You see the worst in people sometimes when they get stressed out, and a husband and wife, and they're fighting, and they're like, they can't agree, and they're like, they finally get through it, and they're like, man, you know what? I'm sorry, man. We were not very good to you and whatever. And it's like, it's cool, man. It's, what? That's what you're here for, is to manage those emotions. Talk them off the shelf at times, or do what is necessary. Bring them into reality. That's what good agents do. But what is happening is you're walking into these houses and you're going, really? And I'm looking at you and I'm going, okay, you're 25 years old. You want to buy this house. I don't need to be a home inspector, go through my, little course and get my little tool belt and my flashlight and walk through this house to tell you, you know what? You're going to spend some money here, and it's overpriced. If you put windows in this house, it's going to cost you $25,000. You know what? The windows are leaking. You could see rain damage. Other agents are looking at it going, don't worry about it. I got a guy that can put those windows in for you. It's no big deal. It doesn't look like it's not wet now. Going, really? So you have to be looking at this thing with your eyes wide open if you're a buyer. You can't always believe or trust the person that you're working for that you decided to hire because you went to college with them or it's your mom's best friend. So, in this alone, I take a lot of heat from my peers because they're like, why do you tell people this? I'm saying it for me. Interview other agents. Interview me and interview other agents. You make the choice. The choice is yours. I don't want you to hire me just based on, somebody said you should call Todd. No, you can interview a couple other people. I might interview you. I might not want you as a client. But the point of the matter is, these houses need a ton of work. And guys, this is big money. First of all, it's hard to find somebody who even knows what they're doing. So they put you through hell just in that. You get a contractor, you give money, they don't show up, they take your money, they run off with it. You never hear from them again. So it's not just a matter of I got a guy, but there's so much in a house that you don't even realize. People aren't even looking at the outsides. Things that are falling apart, the deck that's rotted. That's $10,000, $12,000, $15,000. Guys, it's expensive. So when you look at your bank account and you're looking at that house, you got to say, am I going to be able to, if that deck's going to need to be replaced within 3 years or 5 years, are you going to be able, if it's going to cost you $15,000 or $20,000, are you going to be able to save the money in 3 years, paying the mortgage payment, the taxes and the insurance, your upkeep, your utilities? This is the biggest thing, guys, that I see people make a mistake with. They don't realize they're coming from a 700 square foot apartment or smaller. They're going into a 2,000 square foot house, and they don't even realize that their utility bill is going to triple. Like, well, my apartment electric, yeah, it was high. It got up to $117 or $124 to heat a 700 square foot apartment. And now you're going to $400 or $500 a month to heat and cool the house. Right? So these are the things that we want to educate our first-time buyers, not just young people, it's first-time buyers, because I sold a 70-some-year-old their first home several years ago. So, and that was her first home. I was proud of her. She bought a home. That's what she wanted to do, and she could do it, and she did it. She probably wouldn't be able to afford it today. Well, let's look at this next chart, because I want to tell you guys, I want to emphasize again, if you're a buyer or a seller, this is a commission profession, right? Look at where we are in existing home sales. Look at this trend line. This was in February. Two things I want to tell you about this peak. February is not the best time to sell a house. When we look historically speaking, the best time to sell a house is in April, May. What happened in April, May? What happened in March? March, April, May. We saw existing home sales fall. Now, this chart doesn't go back far enough, because if it did, you would see that we're at 40 and 50-year lows. 40 and 50-year lows in home sales. For this reason alone, you have to be smart and go into this eyes wide open, because you're talking with commission salespeople for the most part, right? So you just want to be careful. The last chart that I want to pull up here, and then we're going to open it back up to some questions and let you guys ask Drew some things here, is I want to look at this. I don't know. I just made it small again. See, I was bragging about my technical skills. What I'm doing is making it smaller and harder for you to read. You might think I'm not being transparent. Look at this chart. This is new single-family houses. This is the sales. So besides the GFC, new home sales in June of 2022 and goes back to 2018 and goes way back here to the 1990s. New home sales are down, and it's not because the inventory's down. It is down in inventory, but if you compare that to lower homes built today as before, and you look at these sales numbers, you would say, well, if there's a limited supply of new homes, why do we see these large subdivisions sitting half built? Why do we see, for the last year and a half, these builders offering rate buy downs to 5.5%? So it's not just, and people want new construction over existing home sales all day long. As a home buyer, you would much more love to buy a new home than somebody's old home that maybe is outdated. Because when you buy a new home, you don't have to do anything there for at least 7 years, maybe even longer, if you're good to the house. I've seen people be hard on houses and tear them apart very quick, but that's not the norm. They would last for quite some time. So anyway, let's open it up, Drew. I want to get you to answer some questions here for our viewers as we're winding this show down tonight, guys. We love you. We love you spending Tuesday night with you. I can't tell you how much I appreciate you. But actually, before we do, I just want to plug a couple things. I want to just, a shout out to a new hire that we brought in our content department here, Steve. We have a new employee, just very proud to say that. We looked for months, and we found a guy doing a great job with us. So we're going to be, as a result of that, we're going to be picking up on something that we've missed a lot of, and that's just general social media posting. And so, get social with Sachs. You can follow us on your favorite social media channel and your audio channels as well. We've been, trying to do a better job on posting, but you're going to see some content in these, platforms. Initially, bear with us. You're going to see the same content as we build our audience up. So we are for the next couple of months going to take a lot of the same content that we're pushing out in short form and blast it out to TikTok, Instagram, Twitter, LinkedIn. You're going to see some redundancy, but I promise you the goal as we build the numbers up to followers, because everybody has their desired platform. But what we're going to do, our goal is to do proprietary content for those platforms. We know the demographics that it serves, the age demographics that each one of these platforms serve. And we know that you all have your own idea or ideal of what you want to learn. And so we're going to start doing more of that You're also going to see a Todd Sachs brand. I do have a YouTube channel, Todd Sachs YouTube channel. You can follow it. That we're going to start to publish more things. I'm going to be focusing that YouTube, that Todd Sachs brand, on really the day in the life of just running a business, trying to give encouragement and motivation to people, our youth that is coming out of college or getting ready to graduate high school and wondering what to do. And, so we're going to start really catering to this, couple, this big demographic, that we want to make sure that we embrace you and give you the right tools and some of the right financial, teachings and that you may not be hearing from other people. And guys, I've been self-employed for 35 years, so I know a little bit about that arena. And the big thing with that, just to stay on the narrative for a second, there's a lot of you people, you're going to learn things like, how to become more valuable at work so you can make more money. We're going to focus on you. Share us with your youth. If one of the best things that we can do for our youth is embrace them, give them hope for a future, and give them what we had. And people, you can either be mad at the Gen Xers and the Gen Zs. Not the Gen Zs, I'm sorry, the silent generation down to the Gen Xers, and you can either get mad at them because they made it and you haven't, or we can teach them, and that's what we want to do. So anyway, plugging the social media, also plugging our amazing broker network like Drew. If you're interested in Florida, reach out to Drew. I promise he's going to do a good job for you. He doesn't have commission breath. I can smell it through the microphone. And he's good. He's one of the good ones. So anyway, you can cruise to SachsRealty.com, click on the map of the U.S. And find an agent in your town. If there's nobody in your town, send me an email. I'll be sure to connect you with somebody, vet them out for you, and kind of stay with you. So one of the things that I can do is stay involved in your deal. So if you're a buyer or seller, this is important. Already got permission from my attorney. So, even though I'm not licensed anywhere else, I can't represent you anywhere else other than Maryland. It's plenty for me. I don't need to be anywhere else. But what happens is I can stick with you, and you can take me along through your entire journey, your entire home buying process, your entire home selling process. You can keep me involved, and I promise you, I'll do it with you. So that means that I'll talk to the Drews out there. I will be involved in the meetings. I will help you as a friend to, make sure that you're not stumbling. That's how committed I am to trying to help you out there. We're a real estate channel above all, right? We teach more than that, but we are a real estate channel, and I'm a real estate broker. So I want to plug that. And I wanted to say one more thing, and I forget what it was, just because it's late at night and I'm exhausted. I don't know. Anyway, I might think about it, but let's get some questions for Drew. One for me. We'll let Drew answer too. How do you vet a realtor in your network? What do you look for? It's difficult for the average Joe. That's you. Thank you, Eddie. You just juggled my memory. I knew what I wanted to say. I have a list of questions. Guys, you have to understand, I get 500 emails a day. I'm not exaggerating. It is overwhelming at times, and most of them are junk. So don't think I get 500 emails. I'm not trying to mislead you of people that are saying, please help me. Most of them are junk. I mean, we publish my email, and I get spammed like nobody's business. It's excruciating. And most of the spammers, they don't even have an unsubscribe, or if they do, it's some HTML that wants to put a virus on your computer. So imagine me. In the morning when I'm trying to drink coffee, it's more like, just stick it in my vein and give it to me intravenously because this is painful. But I do read through them, and I finally get to you. I have a list of questions that you will ask an agent. If you're buying or selling, if you're interviewing an agent, this is a priceless. I'm going to give it to you absolutely free. It sounds like I'm like My Pillow or something, but I'm not. I'm just being honest. I'm going to give it to you free. Send me an email. I'm not going to spam you like these other people do, but send me an email. I've got my list compiled. I'm trying to get more efficient with it. I have somebody helping me with it. If you suggested or hit me up and said, hey, I need this list, and you haven't gotten it yet, it's coming to you in the next couple of days. But email me the list for interviewing agents, buyers or sellers, people like Drew. But how do we vet them? Well, there's a couple metrics that we go by. I can tell you right now, there's agents in our network, they won't be invited back. That's just comes with the territory. And a lot of them are pissed off because they feel my truth telling is directly against their mission. But it's interesting because what I do is I look, well, how many sales have you done? If you're telling me that things are great, you can do it yourself. You can go in and look at how many sales they've done. You go, if you're telling me things are great in your town, why have you only sold 2 properties in the last year or the last 2 years, right? So we're diving in, we're looking at that data, and we're trying to determine, is this somebody that's in touch with the marketplace? Are they interacting now? The other thing is we want full-time agents. Well, this is getting hard because a lot of people aren't making money and they're getting second jobs, second careers. So we got to really tread lightly with that and go, yeah, well, I mean, can they survive on? I mean, the market's down. It's just the way it is. You can only cheerlead for so long. The fact of the matter is affordability is gone and people have woken up to this insanity. So we're kind of trying to say, you know, are they full-time? Are they dual career? You know, so we try and weigh that. But the biggest thing is the reviews have to be high. So we're looking for 4.6, 4.7 or higher in reviews. Now, I don't care if they only have 5 or 10, but they're 5-star. We read the reviews to say, is this a credible review? And you can read a review and tell whether it is or not, or whether it's just a friend giving them, or they're, peer, giving them a peer review. So we're looking at it, we're going, because it's quick to get bad reviews, but slow to get good reviews. So we're examining the reviews, and then really we're trying to interact with our client that we send to them. So it's very smart to include me in an email that you're sending to one of our agent network, because then it tells me, hey, I need to stay with this lead and make sure that they're satisfied. Because we've had them that have come back and said, you know what, I can't believe it, Todd, I love you, but you sent me this person, they're not getting it, they're not they steer me down the wrong path. And we go, really? We dive into it, we look into it, we want to hear what happened, and it's my platform, I can do that. Right, our contracts with our network, basically they're advertisers, right, on our platform. But if I don't think it's a good fit, I could say you're gone, and we will. So we've even considered whether we even want to do it anymore. Honestly, I mean, we know you love it, but it becomes so grueling, in some aspects that we're like, even the ones that we think are getting it are still not getting it. Right, and it's tough. I'm just being 100% transparent with you. So, but we love people like Drew keep us going. People like this guy right here, Victor Ashley in Seattle. I met him face to face. We traveled to him. Thanks for the super chat. This is a real deal too. This is a guy that's a real deal. He's been on our show, and these are people that are committed to serving. They're committed to serving, putting their clients above their own needs. That's the key, guys, when we're doing this. We don't need agents otherwise. If we're not going to do that, we're unnecessary, and AI should just take over our industry and our job. Blockchain and buyers and sellers should just interact and use title attorneys and title companies to write the contracts. If we're not going to be a community of people that are serving our clients above our own needs, we're not needed. You agree with that?
Oh, without question. A prime example, as a buyer's agent, Todd, over the last few months, it's been a little challenging. The rules have changed. When you go see a property, you have to have your clients basically sign a piece of paper saying that, they are with you on this particular property. And, when you're meeting clients for the first time, it's not always the easiest thing to explain. And some that aren't really up to the rules and haven't been listening to what's going on.
It's new for you.
It's totally new.
Right. It's not new for us in Maryland. It's new for you in Florida.
Todd, some agents have told me, I've heard them say, well, just show up at the property, when they want to see it, and just put it right in front of them at the property. Don't explain to them on the phone, because you may not be working with them then. Just show up at the property with the client, and then they have no choice because they've taken the time. They're at the property, and, of course, they're going to want to see it. They're not going to want to walk away. I refuse to do that, Todd. I'm full disclosure, explaining everything, what is going on. When you are honest, when you are working for them like they're a member of your family, and you really, really care, eventually those clients come to you naturally. And that's how I like to distinguish myself and separate myself from other agents out there. It's not just sales, about the sales or the deals, or It's about, hey, the quality of deal. Was your client 100% satisfied and wanting to come back and to refer people to you time and again? That's how I judge a successful agent. That's what I try and be.
I'm going to go one step further, and I love that. I love everything that you said, because a good agent becomes extended family and best friends to their clients. That's a fact. You see them at their most stressful time in the world. Their big decision, you're helping them with a 30-year commitment in a lot of cases, or that's what they're signing up for, even though they may not, most of them aren't there 30 years. That's what they're signing up for. And a big obligation, right? So they need a good agent for resources, for contractors, for people that aren't going to rake them over the coals and screw them year after year after year. But let me go one step further. And this is what I'm going to tell my buyers, because a seller is a little different situation. When you're a seller, you reach out to an agent and you say, come on over to my house and let's sit down and let's talk about me wanting to sell my house. When you're sitting in their house, you get to look at the house. If you're a buyer, do not meet the agent at the property. I'm going to tell you right now, you're doing all the work, buyers. You're finding these houses on your own. For an agent to think that they're going to be, for me to be so arrogant to think that you're going to go to SachsRealty.com and shop for houses, though you can. If you think, if I were to think that you would do that versus going to Zillow or Trulia or Realtor.com, they've done a great job of penetrating your apartment, your living room, your bedroom. They've penetrated, they've gotten there through your phone, through your laptop, through your desktop, and they are all over showing you properties and presenting you with properties. And if you're a seller, you need to remember that, because you got to make sure that you're selling to those people looking online. But if you're a buyer, what I'm going to tell you right now is do not meet the agent at the property. You make that agent sit down with you on a face-to-face somewhere, at a coffee shop, at their office. You slow this train down and you say, you know what, Drew? I really like to see this property, but I'd like to interview you. And I'd like to ask you a couple questions to make sure we're a good fit before we go looking at a property. Because now you need to sign a contract with all across the country with a buyer agent, and they're going to ask you to do it the minute they see you, or they're not going to show you a house. And I'm not so sure I want to sign a contract with somebody that I've never met before. And I don't know who they are. And I'm not a lawyer. So I want you to sit down with the Drews, the Todds, and I want you to interview them. And I'm going to give you this list of questions. If you send me an email, I'm going to send you a list of questions that you can, it has no Sachs Realty on it. Most of the agents don't listen to my podcast anyway, so you're safe, right? They don't like what I have to say, so they're not listening. They're not tuning in. Only the good ones are. And so what's happening is, no, not all the good ones, but there are good ones that aren't listening to my podcast. But send me an email. I'm going to get you this list of questions. It's going to put you in the driver's seat. It's going to take it. It's going to be like, oh, man, I don't really want to ask this question, man, but it's on my list here, so I can blame Todd later. You can blame this guy on a television screen. That's the list of questions I'm going to send you, and it's going to put the agents into a position where you're going to see how they perform. And let me tell you something, if they don't perform for you, they ain't performing for you. Right? 2 4 U's. If they're not performing for you when you meet them, they ain't performing for you when they're negotiating with the seller's agent, or the seller for that matter. So we're going to get you in the driver's seat on that. At Sachs Realty, here we have our auctioneer guy that, broker that comments a lot. We appreciate Matthew and his watching the show. He's one of the good ones, Sachs Realty. So would you say that the adjustments in prices we see, especially in Florida and Texas, is the start of the same deflation we saw in 2008, 2012? So, this is an interesting question. And, answering this back in 2022 would be 100% absolutely we were headed in the same direction. But watching how they suppressed, data, manipulated data, printed money, stimulated the economy, I think, yes, we are going to see something that will be way worse in 2008, 2012. I just don't know when we're going to see it. But I do know we're going to see a correction. We're seeing it now. We're seeing a price correction. Is it going to be 50%, 60%, 80%? Probably not. Are we going to go back to 2019 prices? Probably not, like we went back 5 years in 2008, but we wouldn't need that for it to be another 2008 or 2012. So, if we started seeing 25, 30% price reductions in properties, we would be there and exceed that in a different way, because that doesn't necessarily mean that we're going to see foreclosures. So I think that the difference between what we saw back then and what we'll see now is we're going to see asset prices correct. If people can keep their jobs, if they can keep the job market strong, they may still be able to buy their mortgage payment. Maybe we won't see as many people throwing their keys in because their neighbor bought for a lot less than what they did. Maybe they'll just eat it and they'll just stay on the course and just live there, and it'll be a lifestyle. Maybe we won't see the amount of foreclosures that we saw back then, but I don't think we need to see the foreclosures to see the price correction. I don't think that needs to be a big part. A lot of people want to say that subprime loans were the only reason for that correction, and that's just not true. If you look at the amount of foreclosures on subprime, it far pales in comparison to the ones that are not subprime. It pales in comparison to the foreclosures. So a lot of people that lose their houses, they had conventional mortgages, or they had mortgages for years and years and years. It wasn't just the ones that just recently purchased their home. What I think we're going to see is, a lot of those people are going to they'll still be able to sell their home and get out of it, but they'll have been stripped away of a lot of the fake, unrealistic equity that they think that they have now. The question will be, are they going to extract that equity to survive? Then they'll be underwater. Are they going to take advantage of the equity and strip it away in a HELOC or, a second mortgage to pay off high interest rate credit cards? Then they're going to put themselves in a very vulnerable position if they have to sell moving forward. I think that any correction now is going to last for quite some time. I think it'll be a decade before we start to see. If anything, we're seeing this leveling off. We are seeing this softening, but if anything happens, we're going to see it flatten out and stagflation for a very long period of time if we don't see a massive price correction, which quite honestly would just depend on, in my opinion, what we do in kicking this can down the road. Great question. What happens to mortgage-backed securities if home prices crash 50% or more? Seems to me this could be an elephant in the room. You want to take this one, Drew?
Oh, man.
You might not know a lot about mortgage-backed securities, and that's fine. Mortgage-backed securities didn't start out until I think 2011 or 2012, where the government was buying mortgages, and they were doing that because they had to stimulate home sales, right? So we didn't have this mortgage-backed security business like we saw after the GFC. And what happened was we were damaging the banks and the lenders so bad, through that crisis. It was a disaster, financial disaster, that the government stepped in and said, look, if we don't back these mortgages, we're going to have problems, right? We're not going to see people afford. But what happens when, in my opinion, when they show up is they overcorrect. I'm not saying that we don't need government or regulations and things like that, but what I'm saying is that most of the people that are making the decisions are disconnected with the street level. That's the problem. They're disconnected, right? A lot of people have never really had anything other than a public office job. So they don't know what it's like. And they overcorrect and they react slow. And, they're afraid to say yes, or they're afraid to make policy changes because they're afraid that it will end their careers. And, and so what happens is we start to work against each other and away from each other instead of together. And so I don't think that it's all intentional. I think that, there is a lot of good intention with the corrections and the stimulus and trying to prevent pain. But sometimes we just can't avoid it. We just need a correction. So what will happen to mortgage-backed securities? I don't know, man. They probably would just continue to print and bail it out. It's something that can be bailed out.
I also think that we should, men in the room, is also, you got a situation right now in the Middle East, Israel, Lebanon, something that is a powder keg right now. You've got China continuing to sort of poke us in ways that they haven't ever before. You've got one of our presidential candidates right now is being shot at, it seems like, every few weeks. And there's no reason to think that isn't going to stop, even if he does become president. You have a lot of potential black swan events that could happen. You've got the Russia thing with Ukraine, just a lot of things going on right now that produce anxiety, fear. Throw in the credit card debt you're talking about that right now is just worse than it's ever been in the history of this country. You mix all that together, and that's a pretty perfect storm of things that could happen, Todd, that could really turn this entire thing up on its head.
Yeah, and the thing is, now we're so connected globally, so there are a lot of people that and I don't completely disagree. I mean, I think a lot of people say that we're the cleanest shirt in the dirty laundry, and certainly I'm happy to be an American and I'm happy to be here, and but there are some scary things that are going on. If we were in Canada, I mean, they had worse housing inflation than we have here. But I think that we have hit a point where we need to really start focusing on, again, our youth. And that's the ones that are suffering the most right now. Is they're looking at opportunity, going, man, it's just not there. And that's what we really need to start focusing on. But when we look at let's talk about this mortgage-backed securities. And I know it's getting late and we'll get ready to wrap up here, but let's just talk for a minute about, we have about 4,500 banks in the United States. So when you look at lending institutions with financial notes or commercial notes, and that being 70% on a regional bank's balance sheet, I think what we're going to see is, in this whatever next correction this is, we're going to see a lot of bank consolidation. I mean, we're seeing it now. We're seeing banks closing their branches. So what does it matter for somebody if a local branch is not available to serve them if they're dealing with a top too big to fail bank? And they would probably feel more comfortable in an institution that's too big to fail. And I think that what we'll see as any kind of hardship, a voice I've been talking all day. It's good. Drink some Celsius while you're doing it. But I think what we're going to see is as the next downturn happens, any money that people do have in cash, they're going to end up probably, deciding with all these we'll see bank consolidations and branch closings. My bank that we bank with is closing their branch that's 10, 15 minutes away, and they're expecting me to drive 30 to 40 minutes for banking. Now, guys, we're in the real estate business. We still get checks. That's I don't think that's going to go away anytime soon. I'm not going to drive 40 minutes to deposit it. Well, I'm also going to be looking at, okay, well, this is a regional bank. I may be ending up going with somebody that I'm more comfortable putting money into if we start seeing this correction that I expect. So a lot I didn't cover. We're going to have to pick it up in the next podcast. Drew, any final thoughts, or is there any comments or super chats or anything?
Yeah, there's I'm dealing with some buyers right now. This is just something I know you put the chart up with the times of the year and how February we were on the high and it slowly came down. A lot of folks ask me, is there a best time of the year to buy a home? And I do, from what I have found, Todd, feel that anytime between November 1st and December 31st, that holiday period, because you have a lot of folks that are just looking to unload before the end of the year. They don't want to deal with the taxes. Plus, it's the holiday time. Not a lot of people are in home buying mode. If I'm a buyer, I want to go look at a home when nobody's looking at it, when you don't have other competition, because that's what it's about. So I think that particular time, I know we've talked about a lot of things to look for in buying a home. I think that November 1st through December 31st window, if you're a buyer, at least if you really, really want a home, that's the time to at least go out and just kind of kick the tires on the market and see where some of these sellers are at. I would definitely encourage that, Todd. Not sure if that's something that you would agree with or not.
Yeah, I think 100%, where you have the people that are selling at the holiday time have to sell.
Yes.
No one wants to, have the presents around the tree and be traipsing people through their house when they have family visiting and things like that. If they're selling a house during a holiday period, man, they really want to sell. They're a motivated seller, right? I want to add to that a couple things with the buyers. Watch the MLS like a hawk. You know, you're, like I said before, you're doing most of the work anyway. When you're trying to find a house that you want to buy, study that MLS like a hawk. Look at the days on market. You know, look at the details of the house. You will be able to see if that house had been on the market, if it's gone off the market because a contract fell through, back on the market, new MLS number, back on the market, new MLS number, back on the market. Don't just look at the days on the market of the house without diving deeper into the history of the days on the market. It will tell you a world of intel. Maybe they had a home inspection and it failed, you know, or whatever, or the buyers backed out, whatever the case may be. Watch that MLS like a hawk. Like I said, interview agents. Send me an email. I'll send you a list of agent questions to interview. Throw my email address up one more time. I apologize if you sent me an email on this and I hadn't sent it to you yet. I promise you in the next couple of days you're going to have it. The other thing is, you know, because we built that, you know, database now to be able to share that with you. And by the way, I don't share your email address with third-party people, so don't be afraid to send me the email. I'm not going to spam you. The other thing is, don't get carried away with the process. Know that disappointment is part of home buying. And, you know, when you go out there and you look at a house, you find a house that you really like, don't get overly excited on it. You know, build your excitement as you go through the milestones. Identify the milestones, work with a good agent. They'll say, okay, we got the contract. Offers accepted. Now we're going to go through the home inspection process. This could be good. This could be bad. You know, then we're going to go through, you know, the whatever process, you know, break it down. You know, we got the chimney inspection yet. You know, we had a home inspection. Now we're waiting on the radon results, or we're waiting. You know, have an agent that you feel comfortable is going to step with you, work with you, not pressure you, manage your expectations, calm your level. Because here's what happens, and you don't want to think this. Most of the buyers that go through disappointment are really happy at the end of the day. When they find a house, they're like, man, if I'd have bought that house back then, and you talked me off the shelf, or I was upset, you made me feel better, and this place is so much better, and it checks more boxes and stuff. So you got to keep the hope and the faith that, you know, through this process, that will be frustrating. Manage your frustrations. One of the best advices, if you're, you know, God-fearing, pray. You know, I think that's great. You know, to include that to help keep you grounded and calm. And just keep remembering, guys, commission-based salespeople out there, some of them have commission breath. Stay clear, interview. Drew, man, you're amazing. You're awesome. Guys, check him out. His profile is linked in the show notes. Follow him on social media. I don't even know what your social media is like. You might be like, oh my gosh, Todd, don't tell him that. But if you're looking, Tampa, Clearwater, give this guy a shout.
I appreciate it, Todd. And I'd love to maybe come back on around like February, March after the elections are over. Kind of really interested to see how that affects the overall mood of buying in 2025. But I appreciate it so much. This podcast actually was a really good guide to me as I was getting into the business. A lot of the principles that you taught me, I apply every single day.
Thank you.
I just really appreciate it, man. And for buyers out there that are, you know, hoping and wondering if it's ever going to be their time, hang in there. It's coming.
Thank you for that. Let's look at that poll really quick before we say goodnight. And Drew, what you should do, man, is schedule a trip to Maryland, or if you're close by, you can come and you can podcast in our studio. We could podcast face to face.
Would love to.
So here we go. Fed cuts rates half a basis point, or 50 basis points. I keep saying this wrong, which is 0.5%. And in our poll, 876 votes here. Fed knows is about to hit the fan. 64% of you. Political pressure, 27%. Inflation is under control, 6%. And consumers are ready to spend money, 3%. Guys, we love you. Thank you so much for spending your Tuesday night. You can if you like this video, got a little value out, you can let Drew and I know you did by smashing that thumbs up. Show us some love on that. If you haven't subscribed to our channel, please consider doing so now. Hit that alert bell so you'll know when we upload content like Adam Taggart this Thursday night at 6:30 p.m. See you next time.